14th of August. We're going to get started, and we're going to pick up the pieces where we kind of finished off the other day. Obviously, just to give a quick recap about this concept of supply and demand, we're going to look at a naked chart. We're going to take some of the things we talked about during the course of today, look at the naked chart and think about where you would be trading and why you would be trading in certain locations. It's very important. The key aspect of institutional trading is knowing those questions to those, knowing the answer to those questions. Well, it's knowing the questions as well, because in retail space it's slightly different, isn't it? In the retail space, the question isn't where you're going to be trading, because you're in most cases subjected to indicators telling you where you're going to be trading. It's overbought at this price, I'm going to trade there. It's oversold at that price, I'm going to be trading there, and so on and so forth. And so it's very important that when you start differentiating yourself between, between where you would normally trade and where the big boys are going to be playing, and how the big boys are going to be playing, you can start getting into the right trade at the right price. Now, to start today's order flow class, we're going to talk a little bit about the very, very simple. Again, we'll start with the very, very simple, and we'll move on. But the first thing we want to do is just touch on a trade so that we can get into the chart straight away. And I want you to think about this gold chart. This is a 5-minute gold chart. It's on the December contract. And one of the things you can see that we talked about today was anytime you see a market move from a high print to a low print, draw in the profile. You don't second guess what the profile is going to tell you, but just draw in the profile. Because when you draw in the profile and then you see that the price is obviously at the bottom, any volume node, maybe the 50 line, maybe the top edge, any volume node is a price you must pay attention to. There's a very, very simple and obvious reason why you must pay attention to these areas, because obviously the big boys must have been dealing at those prices for that volume node at that price to exist. Well, that in its own right should be enough evidence for you to say, I better pay attention to that. I better be involved in that trade if I get an opportunity. I better be watching that trade on my screens. So if you've got access to a trading view, you just take a look at this down move here. I mean, you can go back as far as you want, guys. It doesn't make any difference, because obviously all the prices above here are all going to be above here in the profile. So the profile that I'm more interested in is this last leg lower, so that I can see where the volume came in, and obviously down to a bottom edge, you can see the last volume that came in here was obviously a bounce volume. So that could be the distribution. So I'm not really that interested in that, am I? I'm not really interested in the volume at the bottom, because that's distribution volume. And we can tell it's distribution because we've already established what a short covering rally looks like, and we've already established what a long accumulation looks like, and they look completely different. So for example, if I said to you, get a naked piece of paper and draw me a short covering rally, you should obviously draw something very, very obvious, short covering rally. And if I then said to you, draw me a long accumulation, you should draw something completely different, shouldn't you? So what does a short covering rally look like? A short covering rally would look something like this, and you're going to get a V bounce. And a long accumulation would look something like this. You're normally going to get a bounce. It's not going to be as heavy, and you're normally then going to see this, aren't you? So we have the difference between what a short covering rally looks like, which is obviously just what? Profit taking, yeah? It's just profit taking off the bottom edges. Profit taking targets being hit. And obviously this type of trade is still a sell trade. This type of trade is still a sell trade to retest that bottom edge. There's still a sell trade to retest, because obviously nobody's accumulated anything. There's a lot of people I've heard out there, they talk so much guff, it's unbelievable. And what they say is that big pin rejection that you've just seen at the bottom, that's got to be institutional accumulation. And you're like, there was only 200 lots at it. How's it institutional accumulation? What do you think? Those 200 lots have just been split between the top 10 banks and they've got 20 lots each? Woo-hoo! 20 lots? Holy moly! Hold on to your hats. That's going to be a big payday. Or alternatively, that might not be the case. So yeah, this is still a sell trade. And when you see this type of trade here, you know that bounce point And when you look at the volume during that, then obviously if you see the volume POC somewhere here, that's the main part of the distribution, okay? So when you see a bounce like this, we can very, very clearly establish that that's just simply distributions. And obviously what we've got to then do is we've got to then look above that level to see where the last short trade was taking place, so that if we recognize the last short trade, we can come back into the trade again and take the market back to the retest the previous lows, at least retest the distribution price, expect to at least retest the distribution. And then obviously if the market is still bearish in terms of your value models, then obviously there's a very, very good chance that the price will then break to the sell side, and then you'll see this part of the trade developing, which is the long accumulation, won't you? So let's look for the evidence. It's very, very easy to draw a whiteboard and say this is what you should be looking for, but if you then go into a chart and you don't see any of these elements, if you don't see any of these pieces, for me it looks obviously dead obvious when I look at a chart, because I've got, you know, 35 years of experience. But for you guys, I don't know how much experience you've got. Some of you might have 10 years on the chart, some of you might have 20 years, some of you might be brand new to the markets. I don't know. So you're maybe not able to spot immediately the types of short covering rallies, the types of accumulations, but take a look at the gold bottom edge and see if you can see any short covering rallies. Well, the first thing you'll probably be able to agree with me is there's a short covering rally right here, isn't there? Very visual, very easy to recognize. Now, if you can recognize a short covering rally, if you can see that very, very obvious big spike in price, then obviously if we understand that that's a short covering rally coming off that level, if there's going to be an accumulation, it's going to take place below that price point, usually below that price point. But obviously if I then take this profile back a little bit, if I just take this profile back a little bit into the leg down that included the short covering rally, take a look at what you start seeing, guys. Take a look at what you start seeing. You start to see some, obviously this is the last volume node, so that's the covering part of the trade. So the ones that you're going to be paying attention to, remember, this is available at this point on the chart. So what price are you looking for? You're obviously going to be looking for that price, aren't you? That's the price you're going to be paying attention to. So when the price bounces off of that short covering rally, does everybody recognize the short trade? Does everybody see where you should start hunting for your order flow trade in here? It should be incredibly obvious, shouldn't it? If you want to get short using order flow, it's a very, very obvious location to get short. Is there anybody that doesn't know how to draw that profile properly? Now, some of you might say, but I don't have access to market profile. Well, get access to market profile. It has a lot of applications, especially if it's one of these ones that you can set up yourself. But the other way you can obviously do it is just look at the last time we had this time spent at a price. And if you look at this area, you'll see that there's a lot of time spent in here. So not only is there a volume profile node, there's a market profile node, and obviously the difference volume versus time. So this is key. Now, what else is key, guys? Take a look and tell me what else is key that you would have recognized for the short trade. What else is key for the short trade? Miguel's mentioned one of the elements that's key to the short trade. It's a declining volume, but what else is key? Declining volume, which is a fantastic thing to spot because obviously you're going to start seeing that exhaustion print into that level. The round number, isn't it? Do you see the fact that there's a green level just above this volume node? Well, there's a very, very high probability that the market makers are going to run the liquidity into that green area just to see if any sellers have put their stops just above that green. They want to see it. They want to see if any sellers have put their stops, and if there aren't any, well, that's it. That's the trade ready to go now, isn't it? If there are any, then obviously the market maker will pull, try and capture as many stops, and the price might go through it by 5 ticks, 5 pips, 5 whatever chart you're looking at. But the key aspect is you now know where the volume node is. You now know where the liquidity is. There's obviously a level 2 liquidity coming off of that little peak there. Your price comes up into that level, and obviously you're ready and good to go. And we're going to be touching on what level 2 and level 1 is. Okay, slightly different from first and second base, but we'll get into that. Okay, so this is exactly what you're looking for, isn't it, for a short trade? Exactly what you're looking at for a short trade. And as the price obviously trades down, the picture changes. Perhaps it's a long accumulation. We don't know, because you can only accumulate value. You can't accumulate price action. If I said to you, yeah, I've got a lot of brilliant price action I've just accumulated in my back pocket, you go, oh, yeah, okay, what kind of crazy world are you living in? You can't accumulate price action. You can accumulate value. You can accumulate value by trading something. You can accumulate a hoard of paintings that you know are valuable, and you can accumulate them at a certain price. You've accumulated the ultimate value of those paintings because you've seen them, they're cheap, you bought them. So you don't know if this is accumulation. That's one thing you don't know. You have no idea if that's accumulation. But you've got your short trade anyway. Who the hell cares? The short trade was worth $1,000, guys. $1,000 by recognizing one volume node, one liquidity level, 150 pullback, and then a sell-off. By recognizing that one sequence of events, you've just made $1,000. It's pretty significant, isn't it? It's the only location that trade can exist, isn't it? There's no other location on that chart that you're going to go, yeah, well, I tried it here. You maybe took a swing at some short business here. Maybe there was a bit of an exhaustion print or a top edge something forming here. But you always know that at this price, there's always going to be a chance that you're going to get taken up into that liquidity that's above you, isn't there? Because obviously one of the other things we've talked about in terms of liquidity is you create liquidity. Remember that. So if I'm looking at getting this short trade on here, I've drawn it as a very, very simple single line. And obviously that short trade gets a lot more complicated because when price drops and price rallies, there's now two things that can happen. There's obviously the wholesale price level, but there's also another liquidity level that might just start forming, isn't there? If I see price coming away from that level, there's now the second level, which is exactly what you're hoping to see. Exactly what you're hoping to see, because now there's sellers come in. Well, if sellers are coming in early, that means there might well be buyers at higher prices coming in as well. So I know that there might be some buying coming in here, and I know in a macro picture there's definitely going to be some buying coming in here. There always is. So obviously we've now got these two up arrows very close to each other. And what have I told you before? When I see two up arrows, I'm seeing double the opportunity to get liquidity. I can get my bigger size on that trade, assuming the price obviously then comes up, takes out those two key levels, gives me the double size, and obviously I'm now primed and ready for the short play. Wait for it, look for it, understand it, look at the volume, watch the volume developing. If the volume is increasing, you ain't doing that trade, guys. You ain't doing that trade. It will be retested. That volume will be retested by the liquidity hunters. And if it's not, guess what? Pass on the trade. Let it go. Just let it go. There's always going to be another trade coming along, and it might be an algorithmic sell trade somewhere on the breakaway from the top edge here. There might be an algo short trade. There might be another algo short trade, another algo short trade. There's no limit to the number of possible short plays in terms of momentum shorts that you could see on that move. You saw that in oil yesterday, that there was probably like 20 opportunities to go long in one single branch of the move higher. And then there was another 20 opportunities to go short on one single leg of the move lower. There's loads of opportunities, guys. So if you don't see what you want to see or you need to see to be selling a top edge, don't sell it. There's no requirement for you to step into the market and deal when it's not correct. Be very, very aware of that. If it doesn't suit you, just pass. It's better to wait for the right trade. And obviously, if you get to the end of the month and you still haven't taken any trades, you're probably being a little bit conservative. If you get to the end of the week and you still haven't taken any trades, you're probably going to be a little bit too conservative, and you're going to have to step up the game. You're going to have to get a little bit more aggressive and active. Okay, you may be waiting for too much, and it's just about finding that balance that suits you. A lot of people want a lot of action all the time. A lot of people want some action some of the time. Some people don't want very much action at all, and they obviously want a little bit more of a passive style. They want to be a little bit more relaxed and a little bit more choosy in the types of trades they take. They can afford to be choosy because they're not going to be that active. And you know, if you're active and you're choosy, you're going to start struggling because you're going to be looking for, you're going to start getting frustrated, you're going to start doing mistakes, you're going to start getting a little bit agitated, and you don't want that. So when we see this little process here, we know the difference between a short covering rally, and we know the difference between this and a possible long accumulation. Now, we don't know it's a long accumulation because we don't know what's happening in value, but when we see this short covering rally, we do know the price will retest that pin rejection. And in this type of situation, then obviously we're looking for this double liquidity to the upside and then the short trade away from that. Well, that's exactly what happened on that oil, that gold here. We had the level of liquidity just here. We had some liquidity coming off this. Obviously, this is the big volume reaccumulation for that sell-off. And then obviously this pullback back into this key liquidity level also has this liquidity here. So there's buyers coming in above that level, and then there's buyers coming in at the green line. And all of those buyers together give me the opportunity to net short my position, and I can take the price back towards the previous swing low, where I will be doing a little bit of my own distribution. And that'll be the end of the trade. You've got one trade, one hit, one profit. You're finished for the day. Congratulations. That's what trading should look like. It shouldn't be a constant battle of good versus evil where you've got to buy it and then sell it and then buy it and sell it. There's usually one trade or two trades a day that make perfect sense. Think about it, guys. One or two trades a day that make perfect sense. Long bonds. It doesn't go long bond, short bond, long bond, short bond, long bond, short bond. The market doesn't work like that. You don't get an increase in short-term interest rates followed by a decrease 10 times in a row inside of one day. You're either long bonds or you're flat, or you're short bonds or you're flat. Well, the markets are all like that. The gold market's like that. I'm not saying there's going to be one swing, but on average, there's maybe two swings, a London swing and a New York swing. And obviously, if you can find out, they don't always go in the opposite direction to each other. Sometimes they are continuation type patterns. But obviously, your job is to try and identify the London swing, which is why I've told some guys in the room in the past, it sounds to me being nasty, but it's not being nasty at all. If they come in at 11 o'clock, for example, in the London session, I've told them you're better waiting until the New York session. Take an extra 2 hours out, take an extra 2 hours off, and come in for the New York session, because coming in at 11 o'clock, for example, in London, just means you're probably going to start getting our profit taking. In other words, the garbage, the trash. You're going to be trading the little recoveries off of a profit taking level. They might be, if you're a short-term scalper, fine, fair enough. But if you're expecting to start seeing some swings at 11, it's probably unlikely. Probably unlikely. You want to try and get into the desk at 8 o'clock or 7 o'clock, or in our case, we get to the desk at 6 o'clock. That's our starting time on our desk is 6 o'clock London. So when we start at 6, our job is to obviously pick up the overnight news, get ourselves positioned for the Frankfurt Open at 7, try and find the trades between 6 o'clock, 7 o'clock and 8 o'clock, get positioned, and then exit the trade around about 10 o'clock, 11 o'clock, 12 o'clock. And that's why when I come into the room in the morning, that's me exiting my early morning trades. That's the point that I effectively finish my session. It gives me the opportunity, once I've finished my session, to then come into the room and obviously chat about what we've been doing and where we've been doing it and so on and so forth. So it's very important, guys, that if you're going to trade the London session, commit to it. If you're not going to trade the London session, don't drip in late. Don't come in at 11 o'clock and then think you're going to find the same trades. If you want to scalp, absolutely no problem. But don't think you're going to find the big swings. Start thinking about the US Open. Start thinking about the US. What are they going to be doing? What's the price discounting process into the US Open? How are we going to trade it? So let's take this thing a little bit further. So we've already identified this perfect short trade for $1,000. Is that not enough for most people? If you're a two-lot trader, that's a $2,000 day you've just had a couple of days ago. This is the 13th of August, guys, yesterday. This is $1,000, and it was from the US session. Look, there's the London session trade. See it? The London session trade. There's the exit. There's the exit in London. See it? There's the entry in New York, and there's the New York trade. Does that make perfect sense, guys? The London session trade will be very much like all the other session trades. It's going to be around about Frankfurt London Open, and it's going to go on until approximately lunchtime. Lunchtime, 12 o'clock noon. And then obviously this is the New York trade, and it's obviously exactly the same. It's almost an exact parallel line, isn't it? It's almost an exact parallel line, and that's going to cause some people to get really excited. Don't. I've seen plenty of people trying to find these. In the olden days, it used to be exactly what you'd expect to see, but it doesn't work as much now because it's people start front running it and start pushing it and things like that. But you'll see that if I take this line off the chart and put it on that line, it's almost identical. It's almost identical. But it's not identical, guys. It's not even close to identical because obviously I could have taken this line to this point and you could say, well, is that more identical and so on and so forth. Do you know what I mean? What does it tell you? It doesn't tell you very much. The only thing this line tells you is obviously that you're starting to reach down into the same type of target price that London had. And that might allow you to start thinking about a bottom edge accumulation. So there's a London trade and there's a New York trade. If you miss those, realize you've missed them. If you still haven't got a trade in London and it's 10 o'clock in the morning, you've missed the trade, okay? It's already gone, guys. Your job then is to adopt a more scalping style and try and find the order flow to get back into the trade. It's still got some momentum in it. Is value still working for me? And so on and so forth. There are only two trades on most days, the London trade and the New York trade. Just be aware of it. Sometimes if a news release comes out, it can change the trade. So in the Frankfurt Open, for example, we're maybe short gold, and then there's really, really bad news comes out of the UK or Frankfurt, and it's at, for argument's sake, 9:30 in the morning. Well, that's 2.5 hours into the London session. So obviously, as it comes out into the Frankfurt Open, into the 9:30 level, then obviously the price might reverse because of some news. Now that's okay. That's two trends in the morning session. But you're then going back to expecting just a single trend in the afternoon session again, which is why sometimes you get three trends in the day. The sell trade, the news trade, reversal, and then the New York trade, or the sell trade into London, the reversal out of London because of the profit-taking bounce, and then the New York trade, maybe some data comes out at 1:30 and it changes completely the direction again. Some data maybe comes out at 3 o'clock that changes the direction. Some data maybe comes out at 6 o'clock or 7 o'clock, a Fed release, for example, something coming out of the Fed, some statement coming out of the Fed, and that changes the direction. But you don't know these things. What you should always assume is there's a London trade, one, and there's a New York trade, one. That's what you should assume. And obviously when you assume that, how obvious does it start to become about what this trade is? How obvious does it become about what this trade is? It becomes very obvious. It's the New York trade, it's the London trade. Which one do you want to take part in? That's the question. Which one do you want to, which one can you take part in? Because obviously if you come in anywhere in here, your job is to try and catch the pullbacks and the order flow pressure. And obviously if you miss this trade here at the top, your job is to try and capture the pullbacks until you reach this end game type trade at the bottom edge. So how do we move forward from this chart? Well, let's take a look at the next process. Well, we talked about this, as I said. So obviously, I'm going to take this all the way down to the very low print price. And when I do that, of course, you can see not only can you see this big accumulation area that we talked about previously. This is this price here. You can also see that there was another level just here. Now, that's not the distribution price, because this now looks like a distribution price, and this looks even more like the distribution price. This might be an accumulation price. We haven't got value on it. So obviously this could be distribution or accumulation depending upon what's happening with value. And obviously there's this other node here, which could be distribution depending upon what the lower node is all about. Okay, so we'll just mark that on the chart. So these are key areas that you absolutely must pay attention to going forward for your day-to-day. Well, you've just done an awful lot of preparation work for your gold chart today, haven't you? This is us coming into the close of yesterday. I've now got this level here. I've marked it on the charts. I've marked this area here, which is this high volume node. And I've marked this area here as well. And I've obviously got this very, very large top edge level as well, which if it ever gets back up to that, could be the top edge we can watch for again. So let's take a look at what happens. Let's take a look at what happens as we come into today's market. I'll just extend the lines. Because you're obviously going to be looking at these areas and trying to figure out what is going on. And you can see the price approaches this line several times. You can see opportunities maybe to get short, opportunities maybe to get short. It doesn't have to touch the line, guys. It just needs to start showing signs of order flow near the line. And this is all you're thinking about, guys. These are all the key levels. Look at this bottom edge bracket. Once, buy trade, twice, buy trade, 3 times, 4 times a buy trade, a sell trade, a possible sell trade, all the way through the Asian session. And then what happens? Okay, and then what happens is this. Look, we start taking out that liquidity node just there, don't we? We already know there's an accumulation up here. We can see quite clearly that there's another wholesale price level just above us, don't we? Does everybody see that there's a wholesale price level just there? Does everybody now start to recognize the setup that we've talked about before? The setup is the buyer coming in above this liquidity, pushing the price into this liquidity level, and obviously you're starting to anticipate the accumulation or the reaccumulation of the short trade out of that box that we talked about earlier. Every one of these boxes you can draw in your charts, can't you? None of them are secret, none of them are hidden, none of them are beyond the ability for you guys to draw in your charts. So let's see what happens. There's the first sign. There's the first sign of that rejection price. So when the price starts coming up into that liquidity, you start seeing the signs of the early sellers. Now we know those guys are probably the signs of the early sellers. Now we know those guys are probably distributing some of this long trade. There's obviously been some buyers in here. These guys look as if this is part of that distribution. It looks as if it's part of the distribution. Why? Because they're obviously, if it's not distribution and they're actually getting short here, then obviously what's going to happen is they're going to fall victim of that top edge liquidity, aren't they? They're going to fall victim of that top edge liquidity because we know that the market will try and take the price up into that liquidity to try and get the trade on. Now you can see obviously we're starting to see the big volume was on this candle, and we're starting to see the drop off in volumes as we go through this level. And what you're going to be doing obviously is you're going to start using that information to do what? Sell some and sell some. Now look at the time of the day, guys. Look at the time of the day on the chart. It's a little bit late, but obviously this hasn't been a long trade. This is not the New York trade, is it? Surely that's not the New York trade. It's not very big. It's not very, it's only $200. That doesn't look like it's the New York trade. So if that's not the New York trade and this accumulation starts around about 3 o'clock, you're thinking, okay, well, gold, fair enough, 3 o'clock. It still has perhaps 2 hours of really good life in it. You know, so let's see what happens. And obviously what happens is this. This is what happens. This is what happens. Now remember what this area is, guys. Remember what this area is. It's this high volume node. And it all started with this high volume node, which then generated the liquidity, which then took out the liquidity level, which then took out or went back into the high volume node. Well, this level here is identical in most respects to this level, isn't it? Remember what this level was when we first put it on the charts, guys. When we first put this level on the charts, and I took it from the bottom of the market to the top of the market, this level here was this node right here. There's the reaccumulation. In addition to that, in this area, we had that green line just above us, right there. There's the green line just above us. And then that obviously gives you that idea of liquidity, levels, and value. The price sells off. Well, this is exactly the same, isn't it? We've got the accumulation because we obviously take this along to the final bottom edge. We take this along to the final bottom edge down here, and we find these reaccumulation areas. Remember, why are we doing this? Because this is the price that institutions obviously sold a lot more business at. It obviously was a level of real interest to an institution. Otherwise, they wouldn't have sold a lot more business at it. They wouldn't have absorbed buyers coming into that level, which then created the volume that then becomes visible on your market profile charts. So when we come into this area here and we see this node of volume, as the price comes up and it starts doing that crazy dumbass structure of higher highs and everybody thinks the price is going north, and what you then see is higher high, pin rejection, higher high, pin rejection. I can see the liquidity it's going through. I'm going to start selling it. I wouldn't disagree with that short trade. And obviously based on that short trade there, you might start selling it and you might find that you've managed to get $50 on the trade, stops at break even, and then you get scratched. Well, good, fair enough. Nobody said it's going to be the first time you take the trade, guys. Then you get the next break and you go, okay, well, there's the next break. I know that gold's going to be trading probably 4 to 5 ticks above that level. It's trading at 5.4, so I'm going to be starting to put some orders in at maybe 5.9. And obviously you start putting a limit order at 5.9 on the charts. And obviously at that stage, you can see if you're either just getting filled or just missing the fill, you can see obviously that you get almost the top tick price, 5 ticks through the stop. 5 ticks through the stop. If you don't get filled, you should have a sell stop order back at this pink line. As the price goes up here, you absolutely must try and get filled now. If you don't get filled in this trade, you're going to run out of time on the day, guys. There's not going to be any more trends. This is the last shout. This is the last hurrah. You're trying to use the early 230 liquidity. Remember, the 230 liquidity is coming from the cash open, the US cash open. And therefore, the markets start trying to find value in the cash open. And obviously, if the cash open finds value at bottom edges, that's going to start causing this gold market perhaps to start topping out at the top edges. And obviously, what you're now hunting for is the right trade, whether you get it the first time or the second time. That's you now got the right trade. And the price leaves at the 5.5s, and it trades down to 12 evens. You make $550 that day, don't you? Why do you take the profit off here? Because you know this is a distribution price. You've already established this distribution price. You already know what that is. It might be a long accumulation price for all you know. As we drop down below that key liquidity level, that key green price at the very bottom, that every time price goes below it, it gets bought. Every time price goes below it, it gets bought. Whether that's because of an accumulation or whether it's because everybody thinks it's now reached the bottom, well, that's got to be the reason why you take your profits off into this area as well. Now, obviously, we can enhance this trade somewhat, can't we? Does everybody agree that the levels are easy to spot? Does everybody know how to draw that volume profile on your charts? You take it from any high print price and you take it to the low print price. You don't take the bounce. You don't take the reversal. You want to know that during this down move, you want to know where the accumulations have taken place all the way through that. And that's why you got this first sell trade in the first place. That's why you got this first sell trade, because this was the first chart you would draw. And that's what gave you the volume node here and the volume node here. This is why when the price came up to this volume node here, this is why this was the perfect short. And there's the sell-off. And obviously, when the market made a new low print, this becomes the big picture, doesn't it? This becomes the big picture. This is now the top edge. If you wanted to extend it away up to this level, it's not going to make any difference. Those areas remain exactly the same. Look, the line goes through this area here. This shaded area goes through this area here. And if you don't like that, I'll take it up a little bit. And this area here still has that big volume node here. This area still has that volume node here. And obviously, if you wanted to go to the extreme of the even higher print, then obviously this is where a lot of short accumulations took place as well. Okay? So these are all key prices that you've got to be aware of. Now, obviously, when you step into the markets this morning and you're starting to look at this key price, you're saying, well, it's a little bit shy of it, but give or take everything else, I'm quite comfortable and I'm quite excited about the possibility of this trade taking place. The reason why I shortened that is, if you're looking at these levels, I like to look at the gap between where there's a big cliff face. So I always take it down into the cliff face, okay? And that just reminds me that that's where the accumulation takes place rather than the exact single POC print. I like to know about areas. I'm not interested in single prices. We don't play based on a single price. We play based on areas. So when the price comes up into this area, what's obviously the big question that's on your mind? What's your biggest single question now that's on your mind? Is it an order flow question? Is it an order flow question? Well, I would disagree. I don't think it is an order flow question, not at this stage. Order flow should be the last thing you look at, because obviously a lot of people will look at order flow first. And because they're looking at order flow first, what happens on an order flow chart, guys? What do you see on an order flow chart? Noise, 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 faking noise. Hundreds of the stuff. There's little boxes, there's little things, there's little shakeouts, there's little absorptions, there's little rejections and exhaustions all over an order flow chart. If you're watching this first, you're going to be in and out and back to forwards and, thousands of different trades at thousands of different prices, constantly chasing about things. And you're going to be so wrapped up in your order flow chart that you're going to forget about value, levels, and all the things that are going to give you the right macro swing. And this is where a lot of order flow traders end up just burning out. They see all the order flow and they think, holy moly, there's exhaustion prints. I'm going to buy into this, and off they go. And they go, well, wait a second, there's some exhaustion prints at the top, there's some absorption below me. I'm going to sell into that top edge. Let me get into it. Let me get into it. And all the while, they've just become something very obvious. They've become an algorithm. That's all they've become, is an algorithm, and probably not a very good one. It's very difficult to beat the algorithms. We've shown you obviously certain ways that you can start stepping in front of the algorithms. But as an order flow scalper, you're up against the algorithms. That's what you're trading against. So the order flow should be the last thing you look at when you're trying to find the best price, because you're now trying to find the best price, aren't you? You're now trying to find that change of behavior, which we're going to touch on this afternoon. You're going to try and find that change of behavior in the order flow, not just in the price action. And the change of behavior in the order flow should lead to the change of behavior in the price action, shouldn't it? So let's go back to the gold chart. So what else should we, if it's not order flow, what should we be thinking about in here? Then obviously the answer must be value. The answer must be value. Now obviously, one of our favorite value lines is what we call the quality spread, the QS line. And when we get into charts, like currencies and value, which is going to be obviously the majority of next week's course, it's the main part of the value side of it. We're going to talk about a lot of the value lines that we're going to be using. One of our key value lines is what we call the quality spread. And remember, every value line we use is a line that is got billions of dollars of trade decisions causing the line to do something. It's not just a price sensitive indicator. It's not just because one price is doing something against a different price. A value line is a value line because it has billions of dollars of trade creating the line. See the difference between that and a stochastic, or that and an MACD, guys? See the difference? An MACD doesn't have any money creating the MACD. A stochastic doesn't have any money creating that stochastic line. It's just a price reaction to something that's already happened. The lines that we use are billion-dollar trading decisions. Billion-dollar trading decisions. So let's take a look at one of these billion-dollar trading decisions. One of the biggest trading decisions that happens in the world of finance is rotation between aggressive and defensive. Everything we do is almost that type of rotation. It's looking at an aggressive stock against a defensive type stock. It's looking at an aggressive, aggressive situation against a defensive situation. So in other words, the quality line, the quality spread, is looking at people buying junk versus US Treasuries, which are deemed to be zero risk. So when people buy junk bonds, it's because they're obviously must be massively optimistic about the marketplace. We're not talking about any other bonds. We're talking about corporate paper. Okay, we're talking about actual corporate paper. If you're very optimistic about the marketplace, you're going to buy that corporate paper because it's always going to yield you higher yields, isn't it? It's always going to yield higher yields than risk-free treasuries. So obviously, as the price of these things move significantly more, you're going to start seeing that idea, well, they must be really bullish if that line's going up. So in other words, what we look at in terms of a value line on gold is how the sentiment of the market, and the sentiment comes from the quality spread. Are they bullish or are they bearish? Are they buying junk or are they buying bonds? Are they buying treasuries? So obviously when we do the quality spread line, it's ZN, which is the 10-year treasury notes, divided by HYG, which is the junk bond market. ZN divided by HYG is our quality spread. It's one of our main lines that we use on just about every single chart, has this line on it. Let's take a look. What do you think, guys? What do you think? This is a positive correlation to risk. This is a positive correlation, in other words, to gold. ZN divided by HYG. What do you think now about this short accumulation? Has it just suddenly got a lot better? Has it just suddenly got a lot better, guys, at the top edge? IHYG, Chris, if you're going to be trading the London session, IHYG, if you're going to trade the London session, because obviously that's the market that's open, this line is of no use to you until 2:30 in the afternoon. Okay, this line has no use to you until 2:30 in the afternoon, which is just here. Okay, it's just in here. So when you look at this chart, can everybody sense the value that's building? It's no longer about the level, is it? It's no longer about this level. It's no longer about that. If I just increase the size of that, does everybody see what's going on? Look, bonds are getting sold and junk's been getting bought, isn't it? It doesn't mean that bonds are getting sold or notes are getting sold. It means that notes are getting sold and junk is being bought. Well, if they've got an awful lot of junk in the trunk, then obviously they must be really, really optimistic about the marketplace. This is an optimism index. And if the optimism is growing immensely, if the optimism is growing really, really strong here, what the feck are we doing at top edge gold? What are we doing? What we're doing is selling that off that top edge price for that reaccumulation to the short side. That's what we're doing. And obviously at that stage, this becomes a very, very obvious accumulation short above that orange line, because we've already identified the orange line and we've already identified the shaded area above it based on profile. So we've got that matrix of profile and orange lines, and we've now got value. What do we do now? We move to order flow. Because in here, we want to start seeing the order flow changing. We want to stop seeing any new buying coming in, because there's a little bit of volume coming in, but the overall volume, you'll probably agree with me, the overall volume is actually exactly as you would expect to see. The overall volume is dropping, isn't it? Well, that's got to be good news, because what happens when the volume's dropping? That means that the top edge supply is reducing. Sounds bizarre, doesn't it? You keep saying to yourself, well, if supply is dropping, why do I want to be selling it? Because the reason why it's not demand that's rising. demand rising is the only reason you don't want to be selling it. Supply dropping means that you're going to start expecting to see what? Gamed top edges. So all of a sudden, when you see the volume dropping, you think to yourself, okay, we're now expecting to see top edge takeouts. We're expecting to see stop runs. So I can step into this market aggressively when I see it, at prices that I see, at levels that I know about before they happen. And this is how you deal as an institutional trader. You start looking for the key level, which is this orange dotted line. You start looking at the liquidity prior to that, which is this higher print here. You start looking at the value line, and you start looking at the volume when it breaks, and you think to yourself, yeah, that volume's nice and it's low compared to that peak of volume. So that's a good sign. That means supply is dropping. That means we're still expecting to see maybe another game on this one because it's only the first break to the top side. I'm expecting 2 breaks to the top side at least, possibly 3 times a lady. So there's your first break, and there's this first sell opportunity, and you could get your stops at break even. As an institutional seller, we just sell some, and then we sell more. We sell some, and then we sell more in this candle here, which if I can take it away far enough, I'll be able to draw the size of that candle increasing. So we'll sell more, or as much as we can get, obviously, if we can get into that trade. Now, as an order flow trader, you might not find that top edge. There might not be anything in there. There might be no way of looking at that market and saying, yeah, I can see all that element. I can see that absorption. I can see that exhaustion. I can see whatever. But what I can guarantee you with 100% certainty is that as the price then reverses off of that top edge, there's going to be lots of opportunities for you to start picking up some short business, some short business. Some short business. Now, there's going to be some people that are going to start saying, yeah, but what about that line popping hard to the upside here? Would that not start getting you off the trade? The answer is yes, it would. I would start distributing on down ticks. I'm not going to reverse the market, guys. I am looking at this market now as my New York trade. I'm not going to go sell side, buy side, sell side, buy side in the last 2 hours of trading. I'm going to go sell side. I'll take a bit of distribution, and that distribution does what? It buys the rest of my short trade some time, because the green line might just reverse back off. The quality spread might just drop back down to the previous bottom edge. It might not, and I might end up getting scratched out, but I don't think I will, because usually there's one trend of the day. The New York, sometimes called the New York reversal, sometimes the New York bounce trade. But this is what I'm buying. I'm buying myself some time, because I know that even if the value is going up in terms of the risk coming in, the quality spread has suddenly gone very big at that stage. I know that even if that's the case, the institution trades will still take the price lower for that accumulation to start. Agreed? The price will be taken lower, and they're not going to start accumulating it until you start getting some lower liquidity. So even though that value line suddenly pops to the upside, I don't really care, guys. I really don't care. I've already taken some profits. I'm not worried about this line at the moment because it's not taking out the previous high. So obviously I've bought myself some time, and I'm just watching to see the process developing. When it hits into the target price, and I've now ran out of time because it's now 6 o'clock in the afternoon or 6 o'clock in the evening London time, New York lunchtime, I'm thinking to myself, that's it. That'll probably be the end of the trade. Why? Because gold's a kind of crappy market to trade after the New York lunchtime. So obviously I'm going to be looking at just getting off my trade at that price, seeing the volume is increasing still on this bar, but seeing the volume decreasing on the continuation. I'm just going to distribute into that price, and the price bounces off of that level and hasn't done anything else. If you were thinking of initiating a new trade, look at how rubbish that trade's been. It's only been it's only been still $150, $200, but think about how poor that trade has been. It's not the best trade, is it? It's not the best trade to try and be fighting into this crappy phase of the marketplace. But if you're going to do anything in terms of macro value directions, then obviously you've just seen a new drop to the downside, haven't you? So what should you be doing? You should be taking a market profile from the high of the New York session to the low of the New York session, because you want to know where those trades actually took place, where the reaccumulations, regardless of whether you agree with it or not, where did those reaccumulations take place? Indicators, fixed range, come in off the top edge print, take it to the bottom edge print and let go, and then find 2 volume nodes, 3 volume nodes on that chart. I don't want the bottom volume node because that's the distribution. So as I move up, I can see this volume node here, and I'm going to draw that level on my charts, okay? Because that could be a good place to start looking for some short business. I can also see this big volume POC here. That could be a great level to start thinking about tomorrow in your trading. Could be a great level. Now, it's not likely to be because obviously the bigger volume picture will be more important, but it still could be a level that you should be paying attention to. So when we start coming up into these levels, obviously you're going to start paying attention to the fact that there's a possible short trade coming into these price points, and you could obviously have started to work into some of that liquidity at the top edge. So this is a recap of yesterday's work, isn't it? This is just basically us recapping some of the stuff we talked about this morning, and obviously some of the stuff we did yesterday, this concept of making about this morning, and obviously some of the stuff we did yesterday, this concept of making sure you understand where the levels are, what the prices are, what's going on in the background, and how to trade at the right price. It's about recognizing where you should be paying attention and where you should be focusing your efforts. Focusing your efforts is incredibly important. What else was incredibly important about this trade? Well, the time of the day is also very important. Most big trades take place on the hour and on the half hour. Most big trades take place on the hour and on the half hour. And the reason for that is data releases. I've mentioned earlier on today, if anybody hadn't heard me, I mentioned earlier on today, the one time you're not allowed to take a break off your desk is 5 minutes, 10 minutes to the hour, 5 minutes, 10 minutes after the hour. Anytime after that, you can take a break. You can take a break at 10 past or 10 to, you can take a break. You can take a quick coffee break. You can then get back to your screens on the hour and on the half hour. Because if there's going to be a market turn, if there's going to be an end of trend, it's usually going to take place in that 10, 15-minute segment at the hours, okay? That's when it's normally going to take place. Look at where that top edge took place. Look at where the top edge took place, the 4 o'clock fix in London, 1600 hours. Look at where the exit took place, 1800 hours, New York. 2 hours, almost 2 hours exactly, isn't it? Almost 2 hours exactly on that trade. Think about it. Now, there's another reason why you should always pay attention, because things like, obviously you might be saying, well, the LIBOR fix is 11.55. Yeah, but you start seeing it at 12 o'clock noon. The gold has an auction. There's 2 auctions each day on gold. You might not know that, but there's an auction that takes place every single day on gold in London. And it's at 10:30 for the London auction, and it's at 3 o'clock for the US auction. And what you'll normally find is that there's movement in those auctions because that fixes a gold rate for that period. It fixes a gold price for that period. So there's always going to be something that's going to be looked at when you're looking at sort of at 3 o'clock in the afternoon and 10:30 in the morning London times. So you're always going to be watching, what are they trying to do? What are they trying to do here? Well, you can tell straight away they're trying to get liquidity into that top edge short trade. That's what they're trying to do. How do we know that? Number one, because they sold from this level before, market profile. Number two, because we can see that there's a key wholesale price level. Number three, we can see that they take it up once, twice, 3 times a lady. So they're gaining liquidity. They're finding buyers at higher prices. Number four, the whole reason why they're doing it is because the value is dropping. The sentiment in the market is, in this case, dropping as a positive correlation. And obviously in that type of environment, you just don't have any question mark, guys. And then the final piece to that jigsaw is this should be the trade of the day for you guys in the New York session. You shouldn't be thinking about shorts and then longs. You should be thinking about shorts and exiting, and then selling and exiting, and selling and exiting, and selling and exiting. That's what you should be thinking about, guys. Two trends, the New York trade and the London trade. What are they? Have you identified them? Have you thought about them? What are they? What are you going to do? Where are you going to do it? How are you going to get into those two trades? Are you going to wait for the top edge to form and then try and sell the order flow? Fair enough. But just decide how you're going to trade. Decide what you're going to be doing. And then think about how the trade is going to start. Think about how the trade is going to start developing. Now, obviously, this is just one value line. There's the TED spread, of course. If we want to look at the TED spread, we could also look at something like the Japanese yen against the pound as a positive correlation at times. And obviously, when you look at the Japanese against the pound, as the price comes up into this area, there's still value in this trade. There's still plenty of value in this trade here. The price has gone up in the Japanese yen, but it's diverging off the top edge when you make that decision. When the price starts dropping, obviously the Japanese yen spikes and gold drops. Oh, that's okay. That's okay. You take some profits and you put your stops at break even. There's one trend, and this is the one you're in. So let's see how far it goes. This one trend, very, very important. Okay, so let's go back a step. This is obviously more of a recap. So let's go back a step and let's talk about the concept very quickly of the actual responsive initiative type trades. A little bit of a business that you probably understand already, you've maybe heard of before. By the way, if anybody didn't see this trade obviously kicked on for 80 ticks eventually. Unbelievably how badly priced that was in the morning session, and it ended up kicking on for 80 ticks. 80 ticks. That was the morning trade. What happened in the afternoon? We gave a shout out for a bottom edge this afternoon, didn't we? That was the morning trade. What was the other trade? Just hit swing lows, starting to buy against the pound euro. Starting to buy against the pound euro. Look, this is what happened to that trade, guys, live in the room, live on the tweets, called live in the room. It went 47.20s to 47.90s. It ended up adding another 70 ticks to that trade. Another 70 ticks to that trade. Unbelievable, isn't it? Unbelievable. Called live in the room, guys, as well. Called live in the room. Perfect. Okay, so let's get into order flow 101. And whilst I've actually got this chart, I wanted to just show you something very, very simple. And it's actually a trade that makes money nearly every day, by the way, guys. But it's only available for the guys in the London session, I'm afraid. And what we're looking at here is the German Bunds. The German Bunds. And the ECB are active in the marketplace. A lot of Deutsche Bank, for example, is very active in the marketplace. And the first thing they do is they take a directional view straight away on the Bund market. It doesn't happen in the gilt market, because in the gilt market, the Bund market's already open. So the gilt market doesn't have the same characteristics. But the Bund market, when it kicks off, the first thing you'll see, when it kicks off, the first thing you'll see is you'll see a volume node. See the little block trade here, this little blue box here. You'll see that there's volume blue boxes. And as soon as that volume blue box prints, guys, if the price goes above that, it's going to be a buy trade for the session. Okay? Sounds bizarre, but that's what it's going to be. It's going to be a buy trade for the session. And you can see that you try and stick with that trade as long as possible. And obviously that trade stayed as a buy trade for the whole fecking day. Look, it's enormous. 10 euros a tick, 100 euros on a contract value, 10 euros a tick. And that trade went from 68s up to about 48s on the other side for about approximately an 80 tick profit, which is an 800 euro profit on that trade. It sounds bizarrely easy, and it is bizarrely easy. It's just because of the way that they have to deal, because there's no business in prior to this area. There's no business. So they will always adjust to the US rates. They'll always adjust to the overnight rates that's hitting the market, like the Chinese rates, the US rates. So when that block volume comes out and the price goes up, you should be buying the bunds for that continuation. If the price goes up and then goes through the bottom edge, you should then be selling the bunds for the market to move to the downside. Here's the next trade here. Look, there's the open, there's the volume block, and there's the trade. It doesn't make anywhere near as much, but there's the trade. It still makes something. It still makes approximately 200 euros. Not bad for, bearing in mind, not bad for about maybe the first hour of trading. As we scroll forward a little bit, you might be thinking, this is crazy, stupid, easy. It is crazy, stupid, easy, but I thought it was worthwhile taking the chance to show you it. Let me show you today's trade. Let me show you today's trade. You see it? There's the Bund opening. There's the block volume. What are you going to do on Bunds today, guys? You're going to sell 163, 33s. 163, 33s. It opens. You immediately put a sell order in. And obviously within an hour, you've just made yourself another few hundred euros. Obviously what happens next is that this level becomes the very, very top edge price. Look. It's not the best trade because it doesn't develop any further than that bottom edge here. But you can see obviously that that became the top tick price for the day. Bizarre, but it is what it is. It is what it is. It's a bizarre trade, but it is what it is. It's the German Bund market. Obviously tomorrow for the guys that are coming in the London session, we'll obviously show what happened on it. And if you're interested in trading bunds, the open is a brilliant trade on the German bunds. The open is always a brilliant trade because of the book adjustments that need to take place in the German bunds. That's why we make so consistently massive profits on the DAX FTSE, because the first thing we know that's going to happen is there's going to be a book adjustment between the DAX and the FTSE and the overnight equity markets. So if we know there's going to be a book adjustment, I just step into the market, take advantage of that statistical arbitrage, and make myself some nice money before we even kind of get started in the day. Sometimes there's no opportunity. Sometimes in the DAX FTSE, the value is about right. There's no difference between the value and the current price, and therefore we don't bother trading it. But a lot of the times there is a very, very significant book adjustment required. And if we can get the right price, we'll take it. Okay, so sorry to diverge from what we were talking about, but let's get back into this concept. One of the things you'll hear us talking about when we're talking about a price area, one of the things you'll hear us talking about is this very, very simple process. You might be looking at it in terms of a market profile, but what we'll be talking about is premium. So there's premium prices at the top edge. So we might say, for example, do not sell unless we get premium. And the other thing we'll say is obviously this, okay, discount. Don't buy unless you've got a guaranteed discount. And the other thing we'll talk about is obviously fair value. The fair value is the price action fair value. There's obviously the relative value, or the relative value in terms of looking at your value lines, which is going to be distinct from the fair value price, which is showing up on your charts. Okay, so what we're obviously always going to be looking at is the difference between fair value and relative value. That movement between fair value and relative value is very important to us, isn't it? So we've got to know where fair value is. In other words, those high volume nodes become very, very important to us as traders. If we don't know where fair value is, where that big volume accumulation takes place, how are we ever going to know where premium prices are? So when I see fair value, obviously if I want to get short, I don't really want to get short at fair value. I don't want to get short here. If I want to get short, I'm generally going to be looking for premium prices. If I want to get long, I'm generally going to be looking for a discount. Well, every single business that's successful in the world is working on those basic principles, isn't it? If I can't buy, I'll give you examples. If you walk into your local clothes store and you see a nice leather jacket on the hanger there, and it's Gucci, and you go, well, I like that Gucci jacket, I like that. That's $1,000. I'm going to buy that, and you pay the $1,000. It's not in the sale or anything. That's the ticket price. You pay the $1,000 and you take it home, and you put it on eBay because you think you're going to sell it for $1,500. Well, because you paid fair value for it, what's your chances of selling that for $1,500? Zero. Why? Because people could go into the same Gucci shop, buy it for $1,000. Why would they buy it for $1,500? Well, perhaps it's a limited edition, perhaps, but then you're buying something different. You're not just buying a jacket, you're buying the rarity of the jacket. That's what you're buying into. Well, the markets are very similar. If you buy something at fair value, what makes you think anybody's going to take it off you at a higher price or a lower price? If you pay fair value for anything, what makes you think anybody's going to take it off you for a better price? So you've got to always try and strive for premiums. You've always got to try and strive for a discount. And there's some places that we have in our charts called guaranteed premiums and guaranteed discounts. Now, what are guaranteed premiums? Well, inside this world of premium and discount, the very, very obvious is that in a normal market auction process, this is what it would normally look like, of course. We've already covered this. It would normally look like this, wouldn't it? That's what it would normally look like. Now, when we talk about it in terms of order flow, we can start defining this top edge a lot clearer. We can start saying at the top edge, we would start seeing responsive selling. And responsive selling is responding to whatever buyer that's coming into the market. If there's a buyer in the market, we'll respond to that by selling to them. Passive, in other words. So responsive selling is passive. Passive. You've probably all got this already. You probably already know all of this stuff. It doesn't make any difference. Worthwhile repeating. At the bottom edge, you're going to be responsive buying. This is what you expect to see. And the reason why we're doing this is that we're not interested in the definitions, passive as well. Because what we're interested in is the change of behavior at certain locations on the chart. Change of behavior to us as order flow traders or as institutional traders give us huge amounts of clues, doesn't it? So if this is normal, obviously what that means is that if people believe that this is where fair value is, then obviously you're going to buy this price, aren't you? People are less likely to sell, which is why the volume drops off this market. And people will start stepping into the market because they now believe that that is a good enough discount for them to make money, not to the top edge, but back to fair value. They don't expect to make top edge. They expect to trade back to fair value where they're going to sell at retail. You buy it at a discount, you sell it at retail. You sell it at a premium, you buy it back at retail. And this process of auctioning backwards and forwards is the normal auction process. Now, what's abnormal? Well, obviously abnormal becomes something very, very simple. Abnormal becomes anything that's not normal. So if I was to look at an abnormal profile, this would now be an abnormal profile, wouldn't it? Because obviously what's happening is that the responsive buying is now shifting, and the value, the fair value that's starting to appear is now up here, isn't it? Obviously that's abnormal, and we've got to try and establish why that's abnormal. We've got to try and establish why there's so many buyers willing to pay above fair value. Why would a buyer pay above fair value? Well, obviously, in most cases, it's because they must be really, really, really bullish. Because obviously, when you're above these areas, when you're in these kind of locations, it should be very obvious and very apparent about what kind of candle you should be seeing. Because obviously, one of the candles you should be seeing, obviously, is if I look at this bottom edge here, for example, as the price comes off the bottom edge, I would expect to see a candle that looks like this, with exhaustion at the bottom and absorption into the top. Exhaustion, absorption. Because the volume is increasing, of course. The volume is increasing as we go back to fair value. Coming off the top edge, I would expect to see a candle that looks more like this. I would expect to see a candle that looks like exhaustion and absorption at the bottom, because the volume is going to be increasing during that period. So the volume here should be higher than here. That volume must be getting absorbed by somebody as it comes down to fair value. Why? Because obviously if you sell up here, not everybody's going to buy it back at fair value. Some will buy it back above fair value, a little bit above fair value, really above fair value. And that buying from that top edge sell is going to be responsive buying coming in for profit taking, isn't it? So when we see this little process, we obviously can start identifying normal responses. These are normal responses, aren't they? So if these are normal responses, what are abnormal responses? Well, an abnormal response looks obviously something like this. An abnormal response would look something like this. Agreed? An exhaustion print here and an absorption print here. Does everybody agree that that must be abnormal? Exhaustion. Absorption. Yeah. So that's not normal. That's asymmetrical, not normal. And obviously when you start recognizing what's normal and what's not normal, congratulations guys, you've just cracked order flow trading. And a lot of people can go on and on and on about order flow trading, about all the tiny little bits and pieces that they can put on the charts, all the indicators, all the little things they can see on the chart. But in the end, every single thing you do on order flow comes down to this one single point here. Recognizing a change of behavior. Because this is what this is, a change of order flow behavior. And you'll see us talking about COBs. And COB is just simply that, a change of behavior. Change of behavior. And this, in this case, the change of behavior is in the order flow. This is a change of behavior right here. In this case, that change of behavior is in the order flow. Now, in price action, there's a second type of change of behavior. What does it look like? The second type of change of behavior, of course, is that prices are possibly coming down like this. The prices recover off of that level. In other words, there's buyers here. There's this responsive buying effort at the bottom edges. The price comes up. The price comes down. The volume maybe starts building on the sell side. Okay, so the volume starts building. So already you're probably seeing a change of behavior in the order flow. See how order flow is preceding the price action? You'd see a change of behavior in the order flow, and then the price busts through here. The price busts through here. That's a change of behavior, isn't it? But the change of behavior originated perhaps on that candle there. That candle there is possibly this down candle here. This down candle here that's got an exhaustion print at the top of it and an absorption print at the bottom of it. That's a change of behavior candle here, isn't it? So by recognizing that change of behavior, you're probably going to start thinking about the probability that this order flow, this price action level, is going to break and it's going to become a change of behavior as well. Now, when it breaks, obviously you can look for responsive buying coming into the stop run, or it might just carry on and you might see that initiative selling coming into the marketplace. So let's touch on initiative trade. Let's talk about initiative. Well, obviously this is a responsive buy effort. When the candle stops moving to the downside, that's responsive buyers. Okay, that's responsive buyers. When the price moves away, you're normally talking about initiative. In other words, buyers are now taking the initiative, taking price off the bottom edges, and as the price trades higher, that's initiative. And when they hit a top edge and it stops, usually that's going to be a sign of responsive. Well, that's normal, isn't it? That's normal. That's what we've already identified as normal behavior. We've identified that responsive selling, that passive selling at the top edge is normal. And the price starts selling off. That's initiative. The price starts selling off. That's initiative. And what happens is that when we hit this level, we're starting to expect to see that responsive buying behavior. Instead, we see more initiative selling behavior. See the difference? we start seeing more initiative selling behavior, and that puts a lot of sell side pressure on this level. And obviously what happens is all these responsive buyers who are still in this trade, by the way, they're still buying this trade, but all of a sudden, instead of finding a decline in volume, they find an increase in volume, and they say, oh, to hang with this, I'm in the wrong trade here. And they obviously get off their trade, they become sellers, and their selling is usually going to be stops. Well, stops are obviously new initiative selling, isn't it? It's a stop is a market order, and that's going to be initiate trade to the downside, isn't it? And it may well find that it just keeps going. Now, that change of behavior becomes very, very critical. Why? Why is that change of behavior critical? For one very, very simple reason. It's a price that people remember, but it's not just a price that people remember, because the guys that bought here that decided not to get taken out of that trade are obviously going to be sitting back at this price here waiting for the please give me one more chance, I'll be a very good boy from now on type trade. Okay, please just give me my, I'll be a very good boy from now on type trade. Okay, please just give me my exit because I've just blown my account if I don't. And they're all going to be crying for that price to come back up to this level here, just so that they can now sell it and get off the trade. And they get that opportunity to do that, and obviously what happens next is the price obviously buckles, and we see this big sell-off coming away from that level. So when it gets into some of these key levels, that's why we're very, very excited and very interested in ledges on your charts. If we find ledges, we'll find trade opportunities, won't we? If we find ledges, we'll find trade opportunities. We'll start seeing where the buyers are trapped and where the sellers are trapped, perhaps, wouldn't we? That would be reasonable, wouldn't it? So when we look at any particular chart, when we look at any particular play on the screens, and we start looking at, let me just get a chart. Let's see if I can find any trapped traders. I'm going to look for a ledge, guys, so hold on. Okay, so there might be a ledge down here. Take a look at this chart here. This is the euro dollar. It's from yesterday, so it's not far back. We'll take a look at the market profile of this area just coming into this area here. Okay, so I'm going to be interested in if any ledges of any trapped sellers in here. So how do we identify a ledge? Well, let's take a look. I'm going to take the fixed range. I'm going to come off the top edge, and I'm just going to take it down into this area here. Now, what I'm looking for is the ledge on this trade, okay? Because obviously, if all the volume is in this area, if the price goes above that area, all that volume, anybody that's in that area, now obviously there's the ledge. Everybody I think can see the big drop off of the POC. There's still heavy volume here, but it then collapses. There's the ledge price right there, see it? There's the ledge. So obviously that's the trade you should be paying attention to. When the price then breaks hard away from this level, for example, this is a great place to look for opportunities to buy the market. And obviously when the price trades back down into this area, this should be a possible good location for some buy trade, shouldn't it? It should be a good location for buy trade. It's gone through the wholesale price level, so that's a bonus. You can see it starts giving you that breakdown of a once, twice, 3 times a doofus at the bottom at exactly this ledge price. Then obviously you're going to start expecting and anticipating all of the guys that are still short, that sat through all of this move, maybe doubled their trade size. They're going to be saying to themselves, just give me enough to get off of that trade and I'll take it. And what normally happens, of course, is this normally happens. The price normally trades away from the ledge. See it? The price normally trades away from that ledge back up to that previous swing. So when you start recognizing these very, very obvious ledges, guys, just pay attention to them. Give them a bit of due regard, so that when you can put it on your charts, these are good levels. The ledge to the POC. Some people will say, well, why would you have the ledge and the POC? Well, take it from the ledge to the POC, because obviously the POC is the price that there might have been a long accumulation taking place based on value. So if this is a long accumulation, for example, then obviously when the price trades back into this long accumulation level once, twice, 3 times, 4 times, then these could all be opportunities to buy off that bottom edge price, couldn't they? If value was getting better to the upside. So it's very, very important to recognize not only the price action change of behavior, it's very important to recognize the order flow changes of behavior, isn't it? Let's take a little break. I know we've just been going for about an hour 20, so we went 2 hours last time, so we'll take an hour 20. I think we'll take a break here, and when we come back, we'll start moving on now by looking at buyers taking initiative, thinking about the absorption and the exhaustion process again. Okay, so let's take a little 3-minute break, guys. 3 minutes, and then when we come back, we'll get back into the order flow itself.